G'day traders, today we're going to talk about overcoming 4 major trading fears. Stay tuned, we'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. Today we're going to be going over 4 major fears that affects traders on every level, no matter what instrument they're trading. Doesn't matter how successful you've been in the past. Every time you take a trade, there's some degree of one of these 4 fears creeping into our headspace, maybe all 4 at different times. And today we're going to talk about just some of the things that you can do to maybe potentially offset that and improve your trading results, and why it's critical to understand how this impairs your ability to flawlessly execute your trading plan. Number 1, the fear of losing. So, I've been guilty of this in the past where because I didn't want to take a loss, I let small losers turn into bigger ones. And then when I took bigger losses, it affected my psychological capital, and that interfered with my ability on the next trade to actually execute and go into the trade, because I felt like I took a big loss or a few losses in a row, and I was convinced that the next trade was going to be a loser too. And I wasn't actually focused on my best A-trade setups. We talk about building your playbook, and if you haven't done so, go to my homepage, get the 7-step daily routine for high-performance traders. Build your playbook, build your best A-trade setups, journal your trades, set goals, focus on constant progress, work on the trader that you want to become on a daily basis. And one of the key components of that is working on your mindset daily. And so it's important that you build that confidence through consistency and through accomplishment, through executing not only your trades, but understanding that taking losses is part of the game, and why it's critical to take the smallest loss possible. If you start taking bigger losses, or if you're not sticking to your trading plan, you're going to have interference with pulling the trigger, you're going to have analysis paralysis, and not only will you be avoiding pain, you'll also be avoiding future gain because you're not taking the trades that you should be taking. So number 2, fear of missing out, or better known as FOMO. You've got a market, it takes off, you've been sitting around patiently, it takes off, and so you decide to jump in. Then the market works back against you, and you would have got a better entry, or you may not have even gotten into that trade because you see it's a false breakout. So again, not listening to the herd, not following erratic price action, but sticking to your trading plan. If it's on the close of a candle, if it's a breakout, whatever that may be, executing your trading plan as flawlessly as you do in your back testing and in your review, and not getting caught into the emotional, volatile movement of the market, regardless of what's happening. Traders will often, even the most skeptic of any trend at some point gets converted as the trend continues to go. And at some point, towards the end of that trend, the last people that get in, of course, who are the last converts, they're the ones who end up buying high or selling low. Mark Douglas talks about this in Trading in the Zone. One of the biggest problems that a lot of market timers have is that because they believe they know the outcome of the trade in advance, they put too much weight on an individual trade. So they're over leveraged, too much size, and what happens as a result of that is that it impairs their ability to make rational decisions, especially if it goes against them. If they make money on those trades, then they get a little bit overconfident, they take on more risk, or they start taking trades outside of their plan. Or if they take losses, they may enter into revenge type trades or anger trades trying to get that money back, as opposed to just sticking to their trading plan and managing each trade according to their risk management rules, and understanding that it's a probability game over a number or a series of trades over time. So again, you're not missing out on anything. There's plenty of trades, and that's part of following that best trade setup in your playbook. If you've got your frequency of trades, or there's plenty of trades, you don't get caught into chasing trades or fearing that you're missing out on any opportunities. Number 3, fear of letting a profit turn into a loss. I've done that. So you've taken a few losses, you get into the next trade, it starts to go profitable, and all of a sudden you want to scalp off that profit because now you got a winner, and you think at some point it's going to come out and stop you out, and then you continue to watch that trade run after you've gotten out. Now this happened recently on Friday, where the euro yen was in a downward movement. It had trended on Monday, Tuesday, Wednesday, reversed on Friday, Thursday, Friday, and went right back to the beginning of Monday. Now, that was a 10-to-1 trade. Those are the types of trades I talk about, looking for rectangles or geometric patterns like in Schabacker's book, Peter Brandt's material. If you understand how that works, it gets easier and easier to start taking losses, because if your losses are consistently 1R, whatever that size is for you, if it's 1R, 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 and you can get your positive expectancy over a number of trades up to, 5 over 5R, or 4 or 5 or 6 or up to 10R, that's where you start to make your profits on your trading account. Those are the trades that wipe out the small losers, and it's important to hold on to those winning trades to their target, or to extract the maximum amount out of a profitable trade as possible. So when you get into a winning trade, if you're following your trading plan, you're just hitting the proper trade signals as they come, you take that 1R loss, you take that 1R loss, you take that 1R loss, and then you hold on for a 5 or a 7R profit trade. That's what's important. You can't get caught into the emotion of, oh, I had 3 losers, I got to get some of that money back. So the next trade goes up 20, 30 pips and you get out right away, and then you watch it run another 70 pips. So again, have a plan. Map that out. Know what your profit targets are. Know how you're going to exit that trade or follow that trade if it's stalling to get to your target. Have a timing exit, whatever that may be, but try to extract the maximum amount out of your profitable trades as possible, and lose the smallest amount on your losers as possible. And number 4, fear of not being right. Ego and the need to be right are 2 things that can destroy trading accounts. And so they talk about a lot of people who have been very successful in other careers, other professions. They come to trading, they bring their money and their ego, I suppose, to the markets. And because they've been successful in other fields and they're smart people, they've done well academically, they feel that they should be able to do well as well in trading. Well, the market doesn't care who you are, it doesn't care what your credentials are, it doesn't care what your background is or how successful you've been in any other profession. The key component of this is understanding that it's not about being right or wrong. Taking losses is part of trading. And again, it's a numbers game. Taking your losses, monitoring your results over a series of trades, and every trade is just another datum point, as Peter Brandt says, over a number of datum points over time. So it's important that you take the first loss possible. The outcome of any individual trade is completely irrelevant if you followed your rules. If you've protected your downside on the capital, and you've extracted the maximum amount out of a winner and lost the smallest amount possible on your losing trades. That's what's critical. It's a probability game. You need to manage your risk, you need to get good at taking losses, and you need to get really good at letting your profits run. These 4 fears can impair your ability to execute your trading plan flawlessly. And that's what's going to ensure your success over time, is the ability to stick to your trading plan and again, have asymmetrical risk reward, managing your downside, being patient, being disciplined, waiting for your best A-trade setups, and focusing on constant progress, learning something new from every single trade that you take. So hopefully you got some value from today's video, traders. Stay focused on constant progress, work on your mindset daily, build that confidence through accomplishment, be back testing, be accelerating your learning. Take one trade like Mike Bellafiore says and turn it into 10. Study it, review it, put it into your playbook. What did you learn from it? How would you do it better next time? What did you do well? What did you do poorly? How can you execute better on every single trade? Stay disciplined, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.